how to buy a car in your business name and write it off completely, legally, and lower your tax liability. Welcome, guys. My name is James Hill. I'm the CEO of Black Millionaires. We're hosting Finance Fridays today. So I welcome all of you guys in. We do this every Friday at 7 p.m. Eastern Standard Time. And what we're going to talk about today is a topic that a lot of people talk about online, and I see a lot of comments of people who actually don't own businesses. And I can tell they don't own businesses because they talk about writing a car off as if it's just this simple thing. You walk in, sign a paper, and you walk out. There's a lot of different moving parts and complications that if you were a business owner and you had enough revenue to even understand these things, you would know them. But if you're a new entrepreneur or somebody who's looking to do this in your business, this is a great chunk of knowledge that you're going to get. I personally have purchased vehicles in my business, written the whole thing off, and lowered my tax liability. So I'm not just speaking from a place of I saw something on Instagram and I want to repost it and talk about it. I'm speaking from experience. I have CPAs, I have attorneys, all these people I consulted with in order to do this. And I'm going to talk about some of the pros and definitely some of the cons of doing this in your business. So let's get started, right? So, why is this very attractive to any business owner? Why would somebody ever want to put a business vehicle in their name or in the name of the company? Why is that? Well, the reason is obviously you can lower your tax liability. And then another reason is it takes the liability away from you as for personal reasons, right? So that could be considered a pro and a con depending on who you're talking to. I have a friend who is CFO, and he said that's a liability because if you put the car in your name and you hit somebody or something happens while you're in the car, now the business assets are up for grabs. So it's a lot of things you have to think about when it comes to putting a car in a business, and let's talk about it today, right? So I'm gonna show you guys the truck I have personally, tell you why I got it, what I bought it for, and the whole nine. So I'm gonna spill the beans. Okay, so you see this photo here. I'm gonna put it somewhere here, right? Um, Let me put that up there. Okay, so you see the photo. That is a 2021 Chevy Silverado, right? This is a 2021 Chevy Silverado. Now, previously, before I bought this vehicle, I was driving a 2011 Chevy Cruze that I owned outright. So I bought it in college, my third or fourth year. I financed it and I paid it off when I went on my debt-free journey once I got out of college, which I didn't even end because I went and started a business. But that's a whole nother conversation, right? But that was my car, right? And the problem I had with it is it was paid off. I didn't have a payment. I just had the payment insurance. But the problem I had is I kept running into those issues. Some days I might come out and it don't start, or I drive around and I'm delivering packages and the car don't start, right? So I ran into the issue of it becoming a liability when it comes to running my business and growing, right? Because let's say, and this actually happened to me. Let's say you're driving to a networking event or you're driving to meet a client and something happens to your car, right? Your car shuts off, things go wrong. Now you got to call an Uber. Congratulations, I'm so happy they got Uber now. But before that, I would have to call a cab, catch the bus, try to call my girlfriend or somebody to hitch a ride. And that was just very, very inconvenient. So, sitting down talking to my CPA and my attorney, it made financial sense because of the money I was making and the money I had in the bank with my business to actually buy a vehicle. But I was going to pay. So, me as a new entrepreneur, I was going to pay myself a salary and buy it. But my accountant said, why not actually buy it through your business, lower your tax liability so you can get a better car, and you will pretty much break even or save money because you can write everything off associated with the vehicle. So as a new entrepreneur getting started, I'm like, wow, okay, this makes a lot of sense, right? So what I did is I went out and I purchased a 2021 Chevrolet Silverado, and I'm gonna get into some reasons why I actually decided to buy a truck versus a car. But so here's another photo. But step number one, right? Let's get into the meat and greet, the meat and of all of this, right? Step number one: whenever you are trying to put it in your business, obviously you have to be a business owner. So if you're out there and you have a good job and you're trying to write off your truck or your car, it's not going to work, right? You have to actually have a business. So you go out and get an LLC, C corp, S corp, and you apply and get your EIN number for free from the IRS.gov, and you have an LLC and you have a business that's actually operating. Right? This is very important because I see people in the comments saying, I talked to my car dealership about this and they said I can't write this off. Well, that's because you are an employee and you don't have a business, right? So step number one, actually get a business. You have to go apply, get an LLC, get a C corp, S corp. I don't think that's news to anyone here who's watching this, right? Step number two is they're going to run your credit unless you're paying cash, which I wouldn't recommend. Unless you're paying cash, um, you have to finance it, right? So here's some reasons on why you shouldn't pay cash. So the reason you shouldn't pay cash is because whether you get a loan or not, the IRS is going to recognize it as like you paid cash for it and lower the tax liability. So for example, if you got $200,000 in income and you're trying to figure out ways to lower your tax liability, if you got 200,000 in income, that does not necessarily mean you have 200,000 in the bank. So let's just say you have 200,000 in the bank. You can take, let's say you're trying to buy a car for 50,000. You take $50,000 out of the bank and go pay cash for a vehicle just to lower your tax liability. I don't think that's a good idea. However, if you actually go finance it, that same $50,000 or whatever the cost of the vehicle, you can actually still write that off. The IRS, as long as you bought the vehicle, the IRS doesn't care if it's a loan or if it was with cash, right? They just want to know you actually bought the vehicle, how much it weighs, and whatever what it qualifies for, and we're going to get to that. So let's talk about business credit worthiness, right? So when it comes to business credit worthiness, what you want to do is obviously they're gonna have to pull your personal credit unless you have a business that can sustain and has business credit and has done these type of things in the past, and you have shown you can pay off a 30, 40, 50, 70, $80,000 vehicle in your business. This is not most people's situation. A lot of people watching this are probably new entrepreneurs or somebody who hasn't done this before, because if you have done this before, then you would probably not be tuning into something like this because you already know the game. So your credit worthiness, they're going to look at your income, they're going to look at your credit worthiness, your Dun and Bradstreet number. They're going to need all of that, right? And they're going to need all of that. They're going to look, you want to sign up for your NAV account, all of these things to help increase your credit worthiness so your stuff can start reporting. But if you don't have a Paydex score, if you don't have a Dun and Bradstreet number, you don't have any of this, you're going to have to either co-sign or personally guarantee. So what's the difference between co-signing and personal guarantee? And I'll tell you which ones I did. So with the cosign, it actually shows up that you and the business is the owner of this vehicle. So on your personal credit and on your business credit and on your business taxes and everything, you are going to it's going to show that you guys own this vehicle. Okay, why is that an issue? That's an issue because let's say you're trying to go finance a home, you're trying to apply for something else, some type of finance, it's going to show up on your debt to income ratio. So if you want to avoid it showing up as on your credit report, the credit pool is going to show up, But if you want to avoid it showing up on your credit report, you don't want to co-sign because it's going to show up as you are required to pay this on your credit score. And if you are trying to buy a house or something, that might mess with your debt to income ratio. But with a personal guarantee, you personally guarantee that if the business fails, you are on the hook for this loan, and they can legally come for you. But it does not show up on your credit report that you actually are financing this vehicle. That's very important because now when you go out and trying to shop for a home and things like that, it's going to show up that you got a credit inquiry, but it's not going to show up that you have a auto loan on your credit score, and that can help a lot of people who are starting a business but also want to potentially finance a home, or finance something that would make your debt to income ratio a factor, right? So you have to look into that. And again, if you're new to this, make sure you have your paydex score. You get your paydex score from your Dun and Bradstreet number. Dun and Bradstreet is it's kind of like it's the credit bureau for business credit. Personal credit, you got Equifax, Experian, and TransUnion. With business credit, you only have, I believe, Experian, I think it's Equifax and Dun and Bradstreet. You don't have TransUnion. Somebody gonna correct me in the comments below. Who else has did this? Correct me. Let's move on. So again, once you do that, you decide on your personal guarantee or cosign. Let's move on to the next step you need to do in order to finance your vehicle in your business. For one, you want to look at the car payment. Now, just because it's a tax write-off doesn't mean it's a good purchase for your business. And what do I mean? Just because you're lowering your tax liability doesn't mean you still have to pay this vehicle, right? So with you still having to pay this vehicle, you want to make sure you can actually afford it. And also the bank or whoever's financing it want to make sure you afford it. So you have to get your paperwork in order. So get your tax returns, W-2s or 1099s or whatever you're showing to justify your income, because if you're a new business and you don't have enough revenue to support a $50,000 car, they're going to want to see your personal income statements, because again, you are personally guaranteeing or co-signing on this loan, so they need to qualify you as the entrepreneur if things hit the fan and they can't come and get paid from the business. So they're going to do income verification um, through the dealer or the credit union or bank or whatever you're working with. So if you don't have actual income, then you probably should try to figure that out before you try to buy a car anyway. So income verification, you got to make sure you can supply a year or two of tax returns, W-2s, 1099s, or even if you have I've seen this happen. And this is what happened with my first vehicle. I didn't buy it in my business, but I bought it with my personal income. I had an offer letter saying I'm about to get paid this amount, which was a lot higher than I was making at the time. So what they did is made me put an extra $1,000 down payment in order to um, justify the risk of the sign on letter that I had from this new job at Best Buy, and they were able to still approve me for the auto loan. So that's another thing. But if you're buying it in your business, that may not work, right? So again, you're buying it in your business, so you might need a purchase order or something showing you about to get a bunch of income if you don't already have it. All right, let's move on. Again, we talked about paperwork, and when I'm talking to my community, right, the black and brown community, we always fall short when it comes to our paperwork. You can tell somebody's serious about their business if they have their paperwork together. So you got to get your articles of corporation, because the the bank or the dealership, they want to know that you actually own the business, right? So they don't want Joe Schmo walking in and financing a vehicle in somebody else's business name. They want to make sure they can verify your income, assets, all that, but also that you are the owner of the business. They do that through the articles of incorporation and look you up, check the EIN number, make sure you ain't got no liens against the business. Your business credit is right, solid, right. Okay. So make sure you have your paperwork in order. And I would recommend you walk in with all of this, if you're watching this video, in a folder, and when you go talk to the dealership or you go talk to the credit union or the bank, you literally sit this down. So they're going to be so impressed, they're going to have to approve you because even if your stuff is kind of tight, you got your paperwork in order. So your paperwork lowers your risk profile. Somebody see that if they gotta, hey, get this articles of incorporation. Now you gotta run around town to get that. Hey, get your W-2s. You gotta run around. Now you look like somebody who's unorganized. And if you're unorganized, how can you run a successful business? If you can't run a successful business, how can you pay for this car loan? That's how people in banks think. So make sure you walk in with a stack of papers. Add some papers in there just to impress the banker, so you can guarantee your approval. So get your paperwork in order for your business. Let's talk about dealer financing versus outside financing, which is better, right? So, I personally would suggest, if you are buying it in your personal name, to go get outside financing. Don't go to the dealership. Go to your credit union. Go to your bank you got a relationship with, right? But when it comes to business financing, I would recommend you go to the dealership. Here's why. When I called to actually, I work with Chase Bank, and I work with Navy Federal. This is before I was working with Navy Federal. I called Chase Bank and I told them what I wanted to do. I wanted to finance a car. I had this money in the bank. I wanted to finance it through my business. And they told me straight up, the minimum interest rate for a business loan like this, because it will be a business loan, is 7 to 10%. Right? And that's with good credit, good business, all of that, right? 7 to 10%. So I said, okay, that's kind of high. So when I went to the dealer financing, because my credit was good, my business had great revenue, they gave me a 4.5% for a business loan. That's incredible, right? So I would recommend that you go to the business dealership financing, because they have an incentive to sell their financing, because they make money when they package your deal and sell it to banks. So if you are on the newer profile and your risk profile is pretty high and you don't know if you're going to get approved or not, it it's better for you to actually go through the dealer financing, because they know that they're going to be able to make a little extra money off of you, so they'll be willing to take the risk, right? So that's my opinion on it. And again, make sure you negotiate that interest rate, because the interest rate is going to determine your monthly payment, as long, I mean, also with the terms you select. So if you're in a business, I would recommend you stretch the payments out as much as possible, because you are going to get the tax benefits that year if you do it correctly, and I'm going to show you how to do that later on in the video. Or I mean, and this is going to come out of your monthly cash flow. So if you can do 3 years based on your credit, but you also can do 6 or 7 years, I would recommend you do 6 or 7 years. Now you can pay it off as you please. However, I would rather you have a lower monthly payment, um, than you have a lower annual term to pay it off. Right? That's just me to new entrepreneur to entrepreneur. So I would recommend, again, go to dealer financing, try to stretch it out as far as possible, because the bank and the dealership makes more money on the longer loans. So, and it lowers your it lowers your monthly payment. So you would be able to make, um, you would be able to have reserves for your cash flow in your business, and you're not paying $1,000 a month compared to 4 or 500 based on what you're doing. Okay, let's move on. You will need to get commercial insurance. Now, I've had people try to trick me and say, "Look, man, I know you got this in your business, but this is what one dealership did, and I was almost there to sign the paperwork, but I didn't do it because the salesman was trying so hard to sell me on this truck that he told me, he act like he went into the back and he came back and said, "Hey man, you know what? Because you're the sole owner of this business, you can actually cover it with individual insurance. You don't need commercial insurance. You don't need that." And I said, "Oh, straight up, you right?" And for some reason, when I was calling my insurance company, they were not picking up when I was calling my insurance agent. So I didn't pull the trigger that day. My insurance agent just so happened to call me back real late at like 8:30 at night, And she told me, absolutely no. You would need to get commercial insurance to cover it because it sits as a business asset. And if somebody tries to sue you and you got personal insurance, but it's a business asset, the insurance company is not going to pay out. Remember, your insurance company makes money on your mistakes. So if you don't pay, if you don't set your paperwork right, if you try to cut corners, you are going to get bit in the behind on the back end. So make sure you avoid any type of under the table insurance telling you you need personal insurance. Get commercial insurance. Now, commercial insurance is a little bit higher, right? So actually, it's a lot higher. So for me, with the business insurance, they don't go off all the other stuff your personal insurance goes off of. You know, your neighborhood and your driving record, stuff like that. What they take more in consideration is how much is the car going to be worth, because they have to pay it out, right? If something was to happen, they're not paying you; they're paying your business. So they look at things like that. So that's something you have to keep in mind. And they look at if you have an office versus if you're just a stay-at-home business. Small things like that can determine your rate on insurance policies. So make sure you get commercial insurance. Do not try to cut corners. And with me, my insurance is $2,700 a year, right? So let's do the math on that. I don't know how much it is a month because I pay my insurance and things like that in my business up annually because I get a deal on that. 2,700 divided by 12. That's $225 a month. That's pretty high for me, somebody with a clean driving record. Before, when I had my personal car, I was paying probably 580. I'm paying probably about 580. So that's 580 times 2 divided by 12. So I was paying $96 a month. So my car insurance did go up a lot, right? But again, that's all a write off when you have a vehicle in your name. So although it went up, I was able to write it off and lower my tax liability. So that's a benefit of that. But I don't want to sell you guys a dream and tell you, oh, actually, you can get personal insurance. Don't do that. Accounting, right? So when you do finance the vehicle, you pay principal and you pay interest. The good thing about this is you can actually write off all of the interest as a business expense to lower your tax liability, right? You can't write off the principal. And here's why. You already are going to try to depreciate the vehicle. Either you're going to depreciate it over years or you're going to depreciate it in that 1 year. So you can't double dip. You can't write the payments off and get the bonus depreciation or the depreciation, right? So you split the payments up, interest, whatever you pay in interest that year, and they're going to send you a form or they're going to have an online portal to where you can actually report that. But make sure you get that and write that off on your taxes because that's a business expense that you can actually write off. And you can do this, set up your QuickBooks account or your consultant or bookkeeper or whoever. Make sure they're on top of that because that's just one more thing you can write off with this strategy. You can deduct the vehicle from you. So okay, consult with a CPA on this one. But when you put the vehicle in your business name, you deduct the vehicle from your balance sheet. So your balance sheet and your profit and loss and all that. So your balance sheet is going to show you what debts you have on the business, your revenue, stuff like that, right? How much cash you have, and you're going to deduct the value of the car or the truck or whatever you purchase from your balance sheet to lower your tax liability, right? So let's just say you have $200,000 that you have to pay tax on. You buy a $50,000 car and you depreciate the entire $50,000. Now you're going to be taxed on $150,000, right? That for entrepreneurs can save you a ton of money because your biggest expense as a business owner or as an American is taxes. You pay taxes on everything. You pay sales taxes, you pay corporate taxes, dividend taxes, self-employment taxes. You pay taxes on everything. So if you can lower your tax liability with the vehicle you drive, that's very, very important. The 6,000 pound rule, right? Here's what everybody want to know. Here's what everybody is talking about, right? How can you deduct the entire vehicle in 1 year? Because usually what happens is you have to deduct it over a certain amount of time. So you have to take pretty much whatever you buy. If it's over 25,000, you deduct 25,000 that first year and you depreciate that, and then you slowly depreciate the entire value of it throughout the years of operating your business. But with the 6,000 pound rule on Section 179 in the tax code, it allows entrepreneurs who purchase vehicles in their business that qualify over 6,000 pounds to write the entire purchase off in that 1 year. And why is that important? Because remember, we talked about, let's say you do $200,000 in income and you don't want to pay all of this money in taxes. So you go out and purchase a vehicle that operates in your business that you use for business use. And now you lowered your tax liability, right? So that's very important because sometimes lowering your tax liability, you may not make money, but the amount of money you were going to pay in taxes may cover the amount of money you were going to pay in the car payments throughout that year. Which why a lot of people try to convince you and say you're getting a car for free. You're not getting a car for free, but what they're basically trying to explain is the amount of money you saved because you would have paid X amount in taxes. You are now paying that in to cover a vehicle, but you also have the vehicle, right? So that's that's very important. So remember I showed you guys the kind of vehicle I have. I have an F-150. I mean, not an F-150, a Chevy Silverado. Now, a lot of people say, why would you buy a Chevy Silverado? For one, I need it for my merch, right? So if you guys are watching, make sure you go support the merch. But I need it in order to transport my merch and do all this for my team. But it's also over 6,000 pounds. So I didn't want to just write off $25,000 because I made a bunch of money, right? So I wanted to lower my tax liability as much as possible, but be financially responsible as possible. Now I could have went out and bought an $80,000 truck, a $90,000 truck, but I went out and bought a $40,000 truck because it made sense, and I was able to write it off. Um, it just made sense on paper, and it made sense for the lifestyle that I had. And again, I told you I needed a new vehicle, right? So it just all made sense. Now, because I'm a full time entrepreneur, and my household has another vehicle attached to my address, I'm able to write it off as 100% business expense. Why? Because I use it for 100% business expense. Because on the weekends, I have a Hyundai that I can drive. I have something else I can drive, right? So if the IRS ever says you're not driving this 100% for business use, yes, I do. I only drive my truck because it's a gas guzzler on road trips with my team or commuting back and forth to work. Other than that, I'm riding in my girl car. I'm doing my Jody, right? Because I don't want to I don't want to spend all that money on gas. Even though it's a tax write off, doesn't mean it's a good business expense, right? So I would commute around in my girl's car. Um, and because she owned it 50-50, she owned it 100%, I got ownership in that too, right? I had to put my name on the deed. Not the deed, what's the name? The title. So it's small things like that. Now I'm able to write off my entire truck, which is $40,000. I lowered my tax liability by $40,000, and I also got a brand new nice truck, right? And I also was able to package and sell my old car, right? I was able to sell my old car because it still has some life in it. And now I ain't got to pay taxes on none of that money because it was a personal vehicle. And I don't have to go out and buy a new personal vehicle because me and my girl share a personal vehicle. Right? Now, this is not everybody's situation. So, this is why I wanted to explain this. So, with the 6,000 pound rule, it allows you to write off 100% of the business use. So, let's say I was using this 50% personal, 50% business. Now, I only can write off 50 out of that 40,000. Now, I only can write off 50%, which is 20,000. So now, when it comes to that, it may not make sense to go out and buy a truck. I should go out and buy a car. Why? Oh, well, that's if you actually wanted a car. Because we're gonna go to the next slide. I'm gonna tell you guys exactly why on the next slide. But okay, let's talk about this for a minute because this kind of pisses me off when I see entrepreneurs talking about this online. You actually have to have revenue to do this. You actually have to have some revenue to actually have some money to write this stuff off. You can't just go start an LLC tomorrow, go buy a vehicle, and then you try to write off $40,000 and use that as a loss on your tax returns to offset paying taxes personally. That's actually fraud and it's illegal. You can't do that, right? So a lot of people are telling you how to go finance a G wagon, right? But they are also saying you actually got to be able to afford the G wagon. You actually got to be able to afford that, right? So I'm not here trying to sell you guys anything on. I'm just trying to give you information, right? So you must actually have revenue in order to make this happen, unless there's always a caveat to it. Unless your actual business deals with something to where you need, it's a must that you have a vehicle. Give me an example. A chauffeur, a car rental company, um, a tow truck. And we're not just talking about regular vehicles. You can buy a 18 wheeler with this rule. You can buy a tow truck with this rule. You can buy a hot shot and all this stuff with this rule, right? So this covers vehicles in general, motor vehicles, not just trucks and cars every day that we drive. So you actually have to have revenue. So you can't continue to take a loss on your business and not make any money because the IRS is going to audit you and you're going to go to jail. So I want to make sure you guys understand that because that's very, very important because a lot of people are out here giving you guys false narratives and false information, and that's not what we do here. Okay, so I'm going to talk about the 6,000 pound rule um, when it comes to my next slide. Should you lease your car in your business or should you buy your car? Because a lot of times people debate about this. Leasing is more expensive or you should never buy a car because you want to upgrade. Here's the thing. It depends. If you are getting a car personally and you get no tax benefits from it, I probably would lease a car, right? Because I'm not getting the tax benefits. And if I wanted a new car every day, I would probably lease it. And I would also lease a car if I was not planning to write off 100% of it in that year. Because when you buy a car over 6,000 pounds, you can depreciate it over the entire year if it qualifies. And that's why I got like a Ford F-150. And side note, if you Google why, like the most vehicle for self-made millionaires, it's a pickup truck. Why? Because you can write it off on your taxes. Because most millionaires are business owners, right? That could actually take advantage of this. A lot of millionaires, 401k millionaires and stuff like that, they can't really take advantage of this even though they're millionaires. But most of the entrepreneur millionaires, they drive F-150s, and that's because of this reason, the 6,000 pound rule. Okay, now you can lease a vehicle in your business name. But what you can't do is you can't depreciate the vehicle. However, you get to write off 100% of the lease payments and everything associated with the car, oil changes, tires, things like that, gas. So it would make sense. Let's say you wanted to get you a BMW that's not over 6,000 pounds, and you didn't want to buy it because it's only going to allow you to write off up to 25,000 in that first year, and then you have to depreciate everything else over the years because it's not over 6,000 pounds. In this instance, it makes more sense to lease the vehicle in your business name because you are able to write that off more, and that's going to give you a better savings over the long term of owning or having and operating that vehicle compared to buying it, right? So it only makes sense to probably buy it if you can use that depreciation, and you can depreciate it over in 1 year and get those tax benefits and lower your tax liability. So I appreciate you guys. I want to make sure you like, comment, subscribe to the channel. This is all about bringing you information. Most of the people who follow me are entrepreneurs and new people starting their businesses and people trying to scale their business, or entrepreneurs like myself that have actually scaled and have money, but they need to figure out ways to lower their tax liability, right? Those are the core audience, right? So that's why I actually wanted to do a video like this, because I was at the gas station and I was pumping my gas, and my girlfriend came out recording me on TikTok, and she was like, "Give us some free game, right?" And I just talked about the 10,000 pound rule, and it went viral. I had no followers on TikTok, and in about a week, I had 26,000 followers on TikTok. So it showed me that a lot of people were very, very interested in this topic. So I wanted to make sure I brought you guys this information right and direct. So again, I'm not a CPA, I'm not a lawyer. So consult with a CPA or attorney if you want to implement some of these strategies, but it's pretty straightforward. I brought you guys all the steps that I did. I told you guys how much my interest rate was for my vehicle by using these steps, and I told you guys how much I paid for the vehicle and how much tax savings I was able to. No, not tax savings. How much I was able to lower my tax liability, um, about $40,000 by buying this in my vehicle. However, let me tell you guys one more thing. It's a bonus. It's called vehicle recapture, right? And the reason I want to tell you guys about this, because the smart thing to do is, well, I'm gonna just buy a vehicle in my business every year and sell it. That's not that's not a good thing. It's not good because you paid 25% tax on the sale of that vehicle once you take it out of your business. It's called recapture tax, vehicle recapture tax, right? So it's not smart to keep moving in and out because you're going to constantly keep paying that 25% tax. And if you're going to pay that 25% tax, you probably should have just paid the tax anyway and didn't even run the play and buy the car in your name and just got it in your personal name, right? If you just really wanted to rinse and repeat and do that. So I love you guys. Please subscribe to the channel. Make sure you share this out with somebody who you think would benefit from this knowledge, somebody who actually want to purchase a vehicle in their business, in their LLC, so they can get those tax benefits and actually use the vehicle to grow and run their business. So I love you guys. I appreciate you guys. If you want to subscribe to notifications, go to finance-fridays.com and you sign up via email, and we're going to send you out an email and a text blast every day before we come here and bring you guys this information. I love you. Peace.